The VIX just had its lowest close since the end of the bull market in 2021, and this comes as FRC, another regional bank, is failing at the moment, getting taken over by the FDIC this weekend. Mega cap stocks are still going to the moon, especially Meta going up by 15% after mediocre earnings, and SPY end of the week up by 1%, maybe finally breaking the range that we've been in for the past month. And this all comes ahead of the Wednesday FOMC meeting, so there's a lot to talk about this week. This Monday, we started with the Dallas Fed Manufacturing Index. This ended up coming in worse than expectations at negative 23.4 for the month of April versus negative 14.6 expected. And this is down from negative 15.7 in March. And this has been going on for about 12 months now, where we've had all these negative readings in the manufacturing index. So manufacturing is certainly slowing down. And this is a preliminary sign of a upcoming recession. If manufacturing is slowing down, they're doing this because they expect less goods to be ordered in the future. So they're expecting less demand, which means that we're inevitably going into a recession. We'll talk about GDP later, but on Monday we had Coca-Cola reporting earnings, and they actually fell 1% this week after they ended up beating earnings by about 3 cents, with 68-cent earnings per share versus 65 cents expected, where their sales volume was only up by 3% year over year, but their revenue was up by 5%. So what does this mean? If they're selling just barely less goods, but they're selling it at a higher profit margin, that means that they're raising prices, and that means that they're creating inflation in their products. And Coca-Cola is a great example of a company that has pricing power because their items are so cheap at, say, $2 for this Monster can. They can raise that to $3 and people won't bat an eye. But Coca-Cola still ended up falling by 1% this week, I think just because it was a little bit overpriced. I think it was an overcrowded stock going into earnings, and they couldn't break those new highs. And then on Tuesday, we had the CB Consumer Confidence coming in at 101.3 for the month of April versus 104 expected. So a miss on consumer confidence, and this is down from 104 in March. So consumers are feeling less confident about the economy in April than they were in March. And we're also seeing consumer spending starting to pull back. We'll talk about that later. But Tuesday, we had Microsoft reporting earnings, and they ended up going up by 9% this week after posting $2.45 earnings per share versus $2.22 expected. And this is a beat of 9.8% year over year. So this is one of the tech stocks that I would justify being at new yearly highs, whereas other ones like Meta, for example, not so much. Google also reported earnings, and they ended up going up by 1.7% this week after reporting 117 earnings per share versus 106 expected. And this is the second quarter in a row where they had declining ad revenue. And for YouTube revenue, this is actually down by 3% year over year. So less advertisers are going to YouTube and paying more, or we're losing viewership, which is also possible, maybe with other people going to different social media sites. On Wednesday, we had the durable goods order coming in at 3.2% month over month for the month of March versus negative 1.2% in February. So a good improvement in durable good orders. Then the core durable goods came in better than expectations at positive 0.3% for the month of March versus negative 0.2% expected. And this is up from negative 0.3% for the month of February. So good improvements for the durable goods order. And then retail inventories ended up coming in at 0.4% positive for the month of March versus negative 0.1% for the month of February versus 0.1% expected. So with retail inventories starting to go up, that means that retailers can start to discount their items because they have more items in store than they did the month before, and they have to get those items off of their shelves. Excess inventory leads to lower prices. Meta reported earnings on Wednesday, going up by 12.1% this week after $2.20 earnings per share versus $1.96 expected. And they mentioned AI, artificial intelligence, 55 times within their earnings call. So they're using artificial intelligence to try to cater their ads to their user base, which is actually growing. I'm really surprised that Meta would have a growing user interface since their platforms are so old with Facebook and Instagram, but they are seeing user growth and they are seeing more ads being shown to their users, up 26%, but their revenue per ad is actually down by 17%. So net between them, they're actually making more money on their advertisements this year over year. Then on Thursday, you had the preliminary GDP coming in at 1.1% for the first quarter versus 2.6% for Q4, so a major reduction in GDP. And this was expected to come in at 2.0%, so a huge miss for GDP, but the markets really didn't care about this at all. They also didn't care about the initial jobless claims because it wasn't really too much of a shock. It ended up coming in at 230,000 versus 246,000 last week and 248,000 expected. So this was actually better than expected initial jobless claims, and the continuing jobless claims was better than expected at 1.858 million total unemployed versus 1.878 million expected. And this is down from 1.861 million as of last week. So slight improvement for the continuing jobless claims, but if we're looking at this compared to the month of March, this is pretty troubling for the unemployment rate that's coming out on this Friday. Amazon ended up reporting earnings on Thursday, falling by 2.4% this week, with an earnings per share of 31 cents versus 21 cents expected, so a good beat, but they're expecting Amazon Web Services growth to continue to decline for the second quarter. As soon as the earnings report came out, Amazon was going up by 10%, but once the CFO admitted that AWS would be slowing down for the second quarter, it gave up all of that 10% and then some. So it was a very volatile earnings report for sure. And then on Friday, you had core PCE, which ended up coming in at 4.6% year over year versus 4.5% expected. So a surprise to the upside. Not great for PCE, but the markets didn't really care about it. And then this is actually down from 4.7% for the month of February. And then the month-over-month reading came in at 0.3% for the month of March versus 0.3% expected and 0.3% for February. So no change, no surprise. And personal income and spending came in at positive 0.3% and 0%. So consumers are stopping their spending trends of going up versus positive 0.3% and positive 0.1% for February. And the expectations was positive 0.2% personal income and negative 0.1% for personal spending. So consumers aren't slowing down their spending, but they're just remaining pretty flat. And then finally on Friday, you had the Michigan economic report where the consumer sentiment ended up coming in at 63.5 versus 62 for the month of March and 63.5 expected. So no surprise on the expectations and a slight improvement from March. Consumer expectations ended up coming in worse than expectations at 60.5 versus 61.8 expected. And this is actually an improvement from March of 59.2. And the final surprise from the Michigan economic report was the 5-year inflation expectations, which was 3% for the month of April versus 2.9% for the month of March. So a slight uptick in the long-term inflation expectations, which means that inflation is being embedded into the minds of consumers. This is exactly what the Fed doesn't want. They don't want inflation to be entrenched. They want people to think that inflation will finally come down later on in the year, but the Michigan economic report is saying that they're expecting inflation at 3% for the next 5 years, whereas the Fed expects inflation to come back down to 2% within the next 3 years. So we'll see who's right on that. So that's the recap for this week. And then for the upcoming week, we have ISM manufacturing PMI coming in at 10 a.m., where the expectations is 46.7 versus 46.3 for the month of March. And then on Monday, you're going to have SoFi and Norwegian Cruise Line both reporting. On Tuesday, you're going to have the factory orders month-over-month reading at 10 a.m., where the expectations is 1.3% versus negative 0.7% for the month of February. So a positive reading of 1.3% means that the economy would be improving. That means that more goods are being ordered. So that would be a good thing if it does come into expectations. And then the JOLTS job openings is coming out at 10 a.m. as well, where we're expected to see 9.683 million job openings versus 9.931 million job openings in February. So about 300 million job openings are going to be closed according to the estimates for this week. If this comes in worse than expectations, that means there's less jobs available. That means that there's going to be higher unemployment. But there's still about 1.7 jobs available for every one person that's unemployed right now. So there's still a lot of job openings per unemployed person, which means that the labor market is still very hot. But if we're seeing the labor market starting to tighten up because there's less job openings, that would actually be an improvement. And that means that the Fed can slow down in their rate policy. And then on Tuesday, you're going to have Uber, you're going to have Pfizer, you're going to have BP Oil, Marathon Oil, and AMD all reporting on the same day. I'm definitely going to be watching AMD stock for sure. And then Wednesday, you're going to have the ADP non-farm employment change coming in at 8:15 in the morning, where the expectations is 143,000 jobs added versus 145,000 jobs added for the month of March. And then the ISM non-manufacturing PMI is coming out at 10 a.m., where we're expected to see 51.8 versus 51.2 for the month of March. So this would be an improvement for the non-manufacturing PMI, but that's actually what we don't want. We want the non-manufacturing and the services PMI to pull back. That way we don't continue to see the services inflation that we've been seeing for the past year. And then on Wednesday, you're going to have the big event of the week, where we're going to have the FOMC rate decision at 2 p.m., where we're expected to see 25 basis points. There's about a 80% chance of that, or 90% chance of that as of right now. And then we're going to have the FOMC press conference with Jerome Powell at 2:30. I'll probably be going live for that. If you want to see it, make sure to leave a like on this video. And then on Wednesday, you're going to have CVS and Qualcomm both reporting earnings on Wednesday. Qualcomm would definitely be the most interesting pick of those two. And then Thursday, you're going to have the initial jobless claims coming in at 8:30 in the morning, where we're expected to see 240,000 job losses this week, or 240,000 initial jobless claims versus 230,000 as of last week. And the continuing jobless claims, or total number of unemployed people, it's expected to come in at 1,878,000, or 1.878 million versus 1.858 million as of last week. So a slight uptick for the continuing jobless claims is what's expected. And the non-farm productivity is coming out at 8:30 in the morning, where we're expected to see negative 1.9% versus positive 1.7% for the first quarter. So for Q2, we're expected to see productivity continuing to slow down, which means that GDP is going to come down with that. This is kind of like a preliminary GDP report. You can think of it that way. And then Thursday, you're going to have a ton of earnings with Moderna, Peloton, ConocoPhillips, Apple, Shopify, Square, Coin, DraftKings, Lyft, and Carvana all reporting on the same day. Two that I'm watching is going to be Apple and Carvana. And then on Friday, you're going to have the non-farm payrolls coming in at 8:30 in the morning, as well as the unemployment rate at 8:30 in the morning, where we're expected to see 3.6% versus 3.5% for the month of March. But I think this is going to be a huge surprise, where we might see something as high as 3.9 or 4% for the month of April, just based on what we're seeing for the continuing jobless claims. This ended up going up by about 10% from the month of March. So it's likely that we're going to see a 10% uptick for the unemployment rate, going from 3.5% for the month of March to 3.9% for the month of April. But hey, that's just my best guess. The BLS cooks could definitely screw it up. We'll have to see. And then finally, Friday, you're going to have AMC earnings, which is going to come out in the morning. Definitely one to watch. Not something that I'm going to be trading personally, but it'll definitely be volatile. And then for the earnings that I am watching this week, I'm going to be watching AMD, which is reporting earnings Tuesday after hours, where their expected range is $83 to $96, with support levels at $88.94, $85.50, and then $83.72, resistance at $92.03, $93, $94.50, and $96.91. And right now, the RSI is neutral at around 49, and the MACD is bearish with both of the lines just crossing over to negative recently. And then finally, IVP or IV percentile is only at 20 for the last year, so that means implied volatility is incredibly low. That means that call options and put options are relatively cheap compared to previous earnings for the year. So it might be a decent opportunity to go long or go short instead of using spread options. I think if they end up beating their earnings per share and beating their revenue, they could be going above $95. If they beat their earnings, miss their revenue estimates, I think their stock could be above $93. If they miss earnings, beat revenue, I think their stock might slip below $90. And finally, if they miss revenue and earnings, I expect their stock to be below $85 by the end of this week. And then for Apple, they're going to be reporting Thursday after hours, where their expected range is between $163 and $177 by the end of this week, with earnings per share estimates at $144 versus $188 as of last quarter, $152 a year ago, and $149 average for the past 2 years. The revenue is expected to come in at $92.94 billion versus $117.15 billion as of last quarter and $97.28 billion a year ago. Their average revenue over the last 8 quarters has been $95.73 billion, with support levels at 167, 165.11, 163.56, and resistance at 169.86, 171.31, 174.72, and 177.09. Right now, you're seeing very strong RSI at 66 at the moment, but it is diverging from the overbought territory above 72 at the last high that they had. And the MACD is definitely positive at 2.55 as of right now, with a upcoming potential crossover right here. Right now, the implied volatility percentile is at 12, so that means that call options and put options are extremely cheap compared to the previous earnings report. If they end up beating their earnings per share and beating their revenue estimates, I think their stock will be above $180. I think if they beat earnings, miss revenue, their stock will still be above $172. If they miss their earnings somehow and beat their revenue, I expect their stock to be above $165. And finally, if they miss both earnings and revenue somehow, then I expect their stock to be below $160 by the end of this week. That would be a pretty rough sell-off from the recent rally that we've been seeing for Apple. And then finally, Carvana is reporting earnings Thursday after hours, where their expected stock range is between $5.6 and $8.30. Their earnings per share is expected to come in at negative $184 versus negative $97 as of last quarter and $209 a year ago. And their average earnings per share over the last 8 quarters has been negative $131. The revenue is expected to come in at $2.62 billion, where last quarter they were doing $3.02 billion. And a year ago they were doing $3.37 billion. And over the last 8 quarters, they've done an average of $3.31 billion in revenue. They've got support levels at $6.50 and $4.88, and then resistance at $8.09 and $9.05. Right now, the RSI is pretty weak at 37 at the moment, and the MACD is bearish with both lines crossing over to the negative recently. Right now, IVP or IV percentile is at 24, so that means, again, just like the other earnings that I'm watching for this week, these options are going to be cheap going into the earnings compared to previous. If they end up beating their earnings estimates at negative $184 and they beat their revenue at $2.62 billion, I expect their stock to maybe be above $8. If they beat earnings, miss revenue, I expect their stock to be above $7. If they miss earnings, beat revenue, I expect their stock to be below $6. And if they miss earnings, miss revenue for this quarter, I expect their stock to slip below $5 by the end of this week. So those are the 3 stocks that I'm watching for earnings that I'm probably going to be trading. If you want to see what options I'm trading on these stocks, go check out my Discord, link in the pinned comment. Thanks for making it all the way to the end of this video, and thank you to all my patrons and my channel members for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.